Hello students, this is Portfolio Management lecture number 3 and we are having a lot of theoretical concepts to be covered in this particular lecture. Very important for solving your problems also, your questions as well as to understand the topic of portfolio management. Portfolio management, if you go to see, the crux, the main part of portfolio management is involving these theoretical concepts and interpretation and application of this. If you understand the concept, it will be very easy to understand the solving or the solution of a problem. Therefore, the first thing that I will be doing in today's lecture will be I will be explaining all the concepts to you, right from the types of risk, the concept of beta, the concept of alpha, interpretation of beta, as well as two important theories which are going to be covered in this lecture number 3. The first theory is capital asset pricing model, that is called as CAPM theory, and the second theory is the arbitrage pricing theory, or what we call as the APT. Both these theories are important from CMA final point of view. SFM paper has got lots of questions based on this theory. Theory by itself is not important. Understanding the theory, because theory is not going to be asked in the paper, but application of all these theories will be there in your paper. Your paper is full of application of CAPM theory and application of arbitrage pricing theory. So these are the two important theories that we need to cover here, along with other important concepts that will be required from the point of view of the topic of portfolio management. So today, very important lecture. We will be covering all these aspects initially, and then I will come to the problems. Okay. So shall we start with lecture number 3, portfolio management? Okay. So first what we will do is we will start with the concepts. So as I said, first we'll go to page number 89, of my material that is given to you. Okay, page 89. Here you can see that we have got diversifiable and non-diversifiable risk. So first I'll explain to you the concepts. As I told you, lot of important concepts have to be learned, lot of important theory has to be covered before we can come to solving the problem. So everything is new for you. You have to understand everything systematically. Okay. Now, starting with the risk. Risk for a portfolio management, when we are talking about risk, or for security analysis also when we are talking about risk, we say that there are two types of risk. The broad classification of risk is into two categories. One is the diversifiable and the other is non-diversifiable. Total diversifiable and non-diversifiable risk is your total risk involved in a security or involved in a portfolio. What is this diversifiable risk and what is this non-diversifiable risk, and why we should learn, why we should know the interpretation and the application of this, the importance of this. First thing, let us come to diversifiable risk. Out of the total risk, that portion of total risk which can be avoided, which can be done away with, which can be diversified, which can be controlled, is called as diversifiable risk. Now, this diversifiable risk may be specific to a particular type of business, a particular company, or a particular type of industry. So, changes in the price of the stock which are relevant to that particular company or which are relevant to that particular industry and which is not affecting other companies or other industries, that is called as diversifiable risk. This diversifiable risk, another term for this. So you can see that we have got here that portion of the total risk which is caused due to factors which are unique to a particular company or to a particular industry. Diversifiable risk is also called as unsystematic risk. Now, this unsystematic or diversifiable risk can be diversified, can be reduced, can be controlled, can be avoided. By whom? By the investor. So if I want, I can diversify that. For example, I'm walking on the road, I'm walking on the road, and I find that there is a manhole opened by the municipal corporation for cleaning the sewerage. So I know that the manhole has been opened. What will I do? I will diversify. I will change my path of walking and I will take the safer route. But if I don't change my path of walking, what will happen? I will fall into the manhole. So diversifiable risk is that type of risk which should be diversified, which should be avoided. Okay. So how can we avoid this? How can we diversify this? We always say, na, do not put all your eggs in one basket. Meaning, what is the meaning of this? Do not invest all your money in the shares of one company. Because if that company does not perform, or there is some specific diversifiable risk which you have not diversified, then you may suffer a loss. Okay, so it can be reduced or eliminated by diversification. That is, instead of investing in the shares of one company, we can invest in the shares of many companies. Okay, now what is important over here is that we are having different forms of unsystematic risk or different forms of diversifiable risk. So if I look at different forms of diversifiable risk, each one of them I need to discuss so that I can understand what is the concept of diversifiable risk and how it takes place for every company. The first type of risk that is to be discussed here is called as a business risk. Business risk is, let us see what it says. It represents the volatility in the revenues of a particular company. I said that it is specific to a particular company. Now, why will a company's shares, a particular company's shares, fluctuate? Let us say everybody is in the pharmaceutical industry is doing excellent. But my company, called as X Limited, my company, which is X Limited, is not performing properly, is not performing like other companies. So what may be the reason for that? That reason is specific only to my company. All other companies are doing well. So what may be the reason? That my sales policy may be wrong. The product mix that I'm having, that is wrong. Or my management is inefficient. Or the cost of raw materials that I am purchasing, that is very high. So as a result of that, the cost of my product is going to be very high. So my products are priced at a very high price in the market. People can't afford to buy my product. Okay, so there may be some problem that is specific only to my particular business, to my particular company. So like, for example, market conditions, product mix, competition, increase in cost of raw materials, etc. External reasons also can be there, internal reasons can also be there, specific to my particular type of business. Okay, second, we have financial risk associated with the capital structure of a company. Now see, I have told you all the companies in my industry, pharmaceutical industry, are performing well. But my company is not performing well. Why? Because I have got a large amount of borrowed funds which are not utilized properly. So there is a huge financial risk. That is there only for my company because my company has taken large amount of loans, large amount of debts, which other companies have not taken. Other companies have taken only large amount of equity capital. So they are depending only on equity capital. Whereas I have taken borrowed capital and I have to pay large amount of interest. And that amount that is borrowed by me is not utilized by me properly. So as a result of that, I'm having a huge financial risk. Okay. Then there may be certain reasons that I'm not getting loans from the banks because my company is not performing well. Management is inefficient, lot of wastages. So I'm finding it difficult to raise capital, finding it difficult to raise working capital. So these are my financial risks. So associated with capital structure, company which has got no debt financing has no financial risk. Higher the financial leverage, leverage means debt. Higher the financial risk. Okay. Also on account of short-term liquidity, shortage in working capital, etc. Then default risk. Third risk is default risk. Third type of diversifiable risk or unsystematic risk is the default risk. That my collection policy is not good. I'm not going after my customers and collecting the money from them on the due dates. My management is inefficient in collection. So as a result of that, a lot of customers are defaulting. I fail to collect the amount from them, or I fail to understand the nature of my customers. As a result of which, I'm selling goods to those customers who are not having good financial stability. So default risk, non-payment. Now let us come to non-diversifiable or systematic risk. And then we will see as to why we have to study this. What is the importance of studying this? Okay. So now importance of studying the classification that we will see at the end of this explanation. Non-diversifiable or systematic risk. Non-diversifiable cannot be diversified, cannot be avoided, cannot be controlled, cannot be changed. That portion of total risk where it is not specific to a security, not specific to a particular share, not specific to a particular company or industry, but it is at the macro level risk. For example, all the companies will be affected alike. Recent now, we are having this COVID-19, as a result of which there is total lockdown. No business is functioning, no company is working. So all the companies across the board, whether you are a pharmaceutical industry, whether you are in the IT sector, whether you are in the infrastructure sector, whether you are in the power sector, all the sectors have closed down. Everything is closed down. Banks are the only things working, but there also transactions are less. So every company, every business is going to suffer. Not only my company, every company is going to suffer across the line. Changes in government policy. GST has come. GST has affected all the companies, not one single company, but all the companies. So, like this, changes which are going to take place, drought, monsoon is not there, or excessive monsoon floods. Because of that, there may be some risk that is there which is applicable to all, which is affecting all companies. That is called as non-diversifiable or systematic risk. What are the examples here? Here again, there are three types of systematic risk. The first one is called market risk, which are triggered on account of political reasons, social reasons, economic events. There is a war in the Gulf, or there is a war between North Korea and America. So some reason is there because of which our exports may be suffering or imports may be suffering. So market risk, changes in the demand and supply pattern, changes in the preferences of customers, investors' risk perception. So all this amounts to market risk. Okay. Second is interest risk. Now interest risk I can explain in two ways. For example, every company will be having investments, every company will be having borrowings, correct? So now, suppose I have done a large amount of investments and I have invested at 10%. Subsequently, the rate of interest is increasing and it goes up to 12%. So what will happen? My investments are at 10%. The economy rate of interest is 12%, which means that I am suffering a loss of interest of 2%. Now you say, sir, sell off the investment and make new investment. But who's going to buy investments that I'm having, which is carrying 10% rate of interest? Nobody will be buying. So I will have to sell it at a loss so that somebody buys my investment, to sell at a loss. So there will be a loss suffered. Correct? On the other hand, if I have taken a loan at 10% and subsequently the rate of interest falls, then I end up paying a higher rate of interest as compared to others in the economy. So like this, there will be interest rate fluctuations. And because of that, there will be fluctuating rates of interest. Either the income will be affected or my expenditure will be affected. That means my interest as a cost that will be affected. Third that I'm having here is inflation risk, purchasing power risk. High inflation, the purchasing power of money reduces. So this is how we classify the risk as systematic and unsystematic. Unavoidable, unavoidable, systematic risk. Avoidable, unsystematic risk. Okay. Now, what we have to learn from this now? We have seen the classification. Now we have seen the meaning of the two types of risk. What we have to now see is why do we study this? What is the implication of this? How do we measure this? Is there a measure for this? Answer is yes. If I want to measure total risk, then total risk is measured with the help of standard deviation. Total risk, that is systematic plus unsystematic risk, unavoidable plus avoidable risk. If that is to be measured, I will measure it with the help of standard deviation. So up till now, the risk of the portfolio that you were calculating, it was standard deviation. That standard deviation is the total risk of the portfolio, which includes the unsystematic plus the systematic risk. Okay, so that is one thing that you have to study here. Now, let us come to, we have done the first 6 questions. Now some new things that we have to study. Measurement of beta. I have told you that I am going to measure total risk with the help of standard deviation, where standard deviation will measure unsystematic plus systematic risk. But if I want to measure only the systematic risk, only the non-diversifiable risk, then the non-diversifiable risk is measured with the help of beta coefficient. So listen carefully now, because this is a very important concept. Beta is a measure of, I am defining beta now as a measure of non-diversifiable systematic risk. Okay, so I can say that beta is a measure of systematic risk, non-diversifiable risk. This is one definition of beta. Measure of systematic risk. I will say, sir, what about the unsystematic risk? Unsystematic risk should not be measured, cannot be measured. Correct? Why? Because what is unsystematic risk? Something that needs to be avoided, diversified, diversifiable. So it should be diversified. That risk should not be taken. So I give you the example. You are walking on the road. You find that on the road, the municipal corporation has opened the manhole. Okay. Now, will you walk straight into the manhole and say that I have fallen? No. You will avoid that manhole. That means there is a diversification possible. So you should diversify. Correct now? So that is diversifiable risk. Fine. So that diversifiable risk should be diversified. So there is no question of measuring that risk. But there is a way of measuring. There is a way. But you should not be using that because it should be diversified. Non-diversifiable risk should be measured because I want to know how much of the risk is unavoidable. Because that is a risk that I'm actually going to undertake. Okay. So we have to know that total risk can be measured with the help of standard deviation. Non-diversifiable risk can be measured with the help of beta. Okay. Now, there is another definition of beta. Since we are talking about stock, since we are talking about shares, securities, portfolios, I can define beta as a measure of sensitivity. So what I'm saying, beta is beta is measure of sensitivity. Measure of sensitivity. Measure of sensitivity of what to what? Of a stock, of a share, of a security with the market. Market means what? Market means index, Sensex or Nifty. Measure of sensitivity, how the share price behaves, how the share price behaves as there is a change in the Sensex or in the Nifty. So it is a measure of sensitivity. Okay, so two definitions I've told you, that it is a measure of systematic risk and beta is a measure of sensitivity. So these are the two definitions or the two concepts of beta. Followed? Absolutely followed? Okay, now I tell you interpretation of beta. How to interpret beta? That if beta value is given, how to interpret that? Beta can have a value equal to 0. No. Beta can have a value either equal to 1, greater than 1, or less than 1. Three values: equal to 1, greater than 1, less than 1. Okay. First, let us see beta equal to 1 means what? Beta equal to 1 means what? Beta equal to 1 means that share price is going to move, is going to change in the same measure as the benchmark. Now, benchmark may be either Sensex or benchmark may be either Nifty. So, if the Sensex increases by 5%, if the Sensex points increase by 5%, then the price of my share will also increase by 5%. Exactly equal. So if it is increasing, my price will also increase. By how much? Exactly the same amount. Why? Because beta is equal to 1. Beta is equal to 1. Okay. So beta equal to 1 means that my stock, my share is going to move, is going to change exactly in the same proportion as the benchmark to which it is measured, either the Sensex or the Nifty. So if it is the benchmark is Nifty and the Nifty decreases by 5%, the share price of the share that I am holding will also decrease by 5%. That is beta equal to 1. Beta greater than 1. Suppose the value of beta is 1.7 or value of beta is 2.1. Then it means that my share price will be moving more than proportionately as compared to the Sensex. Okay, how? For example, Sensex increases by 5% and my beta of the stock is 1.5. Beta of the stock is 1.5. Sensex increases by 5%. So the share price of my stock will also increase, but not by 5%, more than 5%. So by how much it is going to increase? I multiply 1.5 into 5. That is, it will increase by 7.5%. Followed. So 1.5 into 5. So it is going to, my share price will change by 7.5%. That means more than proportionately as compared to the Sensex. Suppose the Sensex falls by 5%, the share price of my stock will also fall by 5%. No, it will fall more than proportionately. 5 into 1.5, that is 7.5%. That means either side, if it changes, my stock price is going to change more than proportionately. I say that my share, my stock is an aggressive stock or a volatile stock. Aggressive stock, volatile stock, risky stock because the changes are more than proportionate to the Sensex. Clear? If it is less than 1, suppose you have your beta value of a company stock is 0.5. 0.5. It means that if the Sensex increases by 5%, my stock price will also increase by 5%. No, my stock price will increase by 0.5 of 5%. That is 2.5%. So less than proportionately as compared to the Sensex. If the Sensex is increasing by 5% and my beta is 0.5, the share price will increase by 2.5%. If the Sensex falls by 5%, my share price will fall by 2.5%. Okay, indication. This is the implication. This is the interpretation. So such a stock which is having less than 1 is called as a conservative stock. Conservative stock. Okay, so we have beta coefficient indicates risk of the stock. Greater than 1 indicates above average risk and it is more risky as compared to other. Less than 1 are below average conservative stock. Followed? Clear? Interesting. Now let us come down to how to measure beta. There are two formulas that I have given to you. The first formula is, I will be using either depending upon what data is given to me. First formula is covariance upon variance. Formulas have given to you. Covariance upon variance. Covariance formula is summation of P into x minus x bar into y minus y bar. But suppose probability is not given. Let us say that probability is not given. Then in that case, what will I do? Then this will be divided by n minus 1. Statistics, you must have studied sample and population. So we are going to, if it is sample and population, depending upon what you are taking, either it is divided by n or n minus 1. Don't have to go into the technicalities of that. You simply have to study if probability is not given, I will divide by n minus 1. Number of values given, minus 1. The 6 values are given, 6 minus 1. If 10 values are given, 10 minus 1. Okay, so it is like that. Same way, variance I have told you, summation of variance is what? Summation of p into x minus r the whole square. Again, if p is not given or x minus r means x minus x bar. I have told you x bar is nothing but r, average. Suppose here also you find that in the calculations the probability is not given, then no problem. Instead of that, I will divide by n minus 1. So what happens? Covariance upon variance. Now see what is happening. Covariance upon variance. So this upon this. So n minus 1 cancels. So what do you get? Summation of x minus x bar into y minus y bar upon summation of x minus x bar the whole square. Now here what is going to happen is that one of the x or the y will be the security and the other will be the market. So instead of writing x minus x bar, what I can write over here is s minus s bar, that means security. I'm going to change this now. Okay, it will be what? It will be s minus s bar, security, into m minus m bar, that is market. Average of security, average of security returns and average of market returns. S minus S bar, S is security, M is market. Denominator, it is variance of market. You can see that M over there. So it is variance of market. So it is M minus M bar, the whole square. M minus M bar, the whole square. Followed? Any difficulty? So this is the formula for beta. This is the first formula. Second formula, Simple. Correlation coefficient R of SM. R of SM. Correlation coefficient. SM means what? Security with market. Correlation coefficient of security with market into risk of the security upon the risk of the market. Okay? Risk of the security and risk of the market. Point is clear? Okay? So, two formulas for beta, very important. You have to study the two formulas. There is no way that you cannot study the two formulas. Up till here it is clear? Fine. Shall we proceed? Now, next thing that we have to know, standard deviation versus beta as a measure of risk. Theory question. Theory question. Very important. Which is better? Standard deviation is better or beta is better? Debate. So you will say, sir, standard deviation is going to measure total risk. Beta is going to measure only the part of the total risk, that is systematic risk. So how can we say which is better? There is a reason. There is a point that we have to discuss here. Okay, so let us go through what is given to us and try to understand what is the main part of my answer. What is the main part of my answer? They have said that risk is classified as diversifiable and non-diversifiable. Market does not reward for a diversifiable risk. Very, very important statement. What they are saying? Market does not reward for a diversifiable risk. Since investor himself is expected to diversify the risk. If the investor does not diversify the risk, cannot be considered as an efficient investor. Market therefore rewards an investor only for non-diversifiable risk. Sir, what is this now? You are saying that standard deviation is used as a measure of total risk. Beta is used for non-diversifiable risk. Now you are saying that market does not reward the diversifiable risk. That is what I told you. That diversifiable risk cannot be calculated, should not be calculated because it should be diversified. Let us take the same example. You are walking on the road, manhole is open. Okay, you know that manhole is open, but you look on top, look in the sky, and you keep on walking, and then you fall in the manhole. And then you say, "Arey, I've got injuries now. I should be compensated by the municipal corporation because they kept the manhole open." Will you be rewarded for that? Will you be compensated for that? No, no. You have to look down and walk. You are not supposed to look in the sky and walk. Correct, now? So, it was a diversifiable risk. You should have diversified. You have not diversified. That is your problem. So, we cannot award you. We cannot compensate you. Correct. So, rewards an investor only for non-diversifiable risk. This is very important. Only for non-diversified. Therefore, I calculate beta only. Measure of non-diversifiable risk. Okay. Beta of a stock measures the sensitivity of the stock with reference to a broad-based index. This is what I told you. Second definition. Beta is a measure of sensitivity of the stock with the index. Okay. Now come down to the next paragraph. If we have a choice between beta and standard deviation, we should prefer standard deviation because it takes care of both systematic and unsystematic. Normally, if you ask me, up till now what we had been doing, we had been calculating only the standard deviation. The reason for that is there. Why I was calculating only standard deviation? I was calculating only standard deviation because that gives me the broad picture, the broad idea, the total risk that is involved in the stock. I know that out of this, some part is going to be diversified and I will not have that much amount of risk. But I want to know what is the maximum risk that I may have. So standard deviation. Maximum risk, standard deviation. But now here there is a difference of opinion. Some advisors have a different view. They are of the opinion that investors with long-term horizon, investors with long-term horizon should consider standard deviation. Investors with short-term horizon should be having calculation of only beta value. Because in the long term, we have to take into consideration total risk. In the short term, we have to take only the short term risk, that is a beta. So they say that which is better? What is your conclusion? We don't write conclusion which is better. We say that if the investor is looking at it from the long term point of view, he should measure standard deviation. And if the investor is evaluating from the short term point of view, then he should go for the beta value. Okay, have you understood? So in the short run, beta is a better measure because any good or bad news is likely to have immediate impact on the market and will have impact the price of the security. Now you understood why we are doing beta and all these things. Systematic risk, unsystematic risk, non-diversifiable, diversifiable. Up till here it is clear now. So you've got a lot of things to study. All these things are new for you. Therefore, I said that we need to study first the concepts so that we understand the topic better. Now come to capital asset pricing model, CAPM. Okay, what does CAPM do? Why we are studying this systematic and unsystematic risk? That is because when we do the capital asset pricing model, the main crux of the theory, the main part of the theory is that the theory explains from where did we get this non-diversifiable, diversifiable. We got this from CAPM only. The CAPM theory tells us that risk is of two types. Okay, so you can see that CAPM classifies the risk into. So the theory, the capital asset pricing theory, is classifying the total risk into systematic or non-diversifiable and unsystematic or diversifiable. This is the point where the total risk is divided into two parts. This is the theory which advocates, which proposes that the total amount of risk should be classified into systematic and unsystematic. Okay, that is why we were learning. Bifurcation of the risk into systematic and unsystematic risk leads to the conclusion that a portfolio may be an efficient portfolio. Efficient portfolio, I have to do this. I have to do this. So when is a portfolio an efficient portfolio? If it does not have an unsystematic risk, if it does not have that diversifiable risk, because diversifiable risk should be diversified. So after diversifying, I should be investing. Then only that particular portfolio is called as a efficient portfolio. Okay. Every investor automatically avoids the unsystematic risk when he adds more securities to the portfolio. That is why a rational, this is important, rational investor prefers to hold a well diversified portfolio for which unsystematic risk is more or less eliminated. So why we are making this classification systematic, unsystematic? Because the theory proposes, which theory? CAPM theory. The theory proposes that there are two types of risk. Okay, and the theory now proposes that a efficient portfolio is one in which the diversifiable risk is eliminated, is minimum or eliminated. Okay, now this formula is important for us. Systematic risk of stock in relation to market risk, beta square into sigma m square, beta of the stock, beta of the stock, of the share, of the security, sigma standard deviation, risk of the market, sigma square, that means variance of the market, beta of the market, beta of the security into variance of the market. Okay, Now this can also be written as beta into sigma m the whole square. Beta into sigma m the whole square. Correct now? I can write it like this. Clear? Up till here it is clear. So this formula has to be studied. Very important formula. Will come for application. Now let us see assumptions of CAPM. Assumptions of CAPM. 7 assumptions. Sometimes in examination, they ask you only the assumptions of the theory. They don't ask you the entire theory. Because theory normally everybody knows that CAPM theory has divided the total risk into systematic and systematic, blah blah blah. That is known to everyone. Assumptions. People tend to forget. People don't study. So let us see what are the assumptions. Investors are generally risk averse and diversification is needed to reduce the risk. Investors generally avoid the risk, want to minimize the risk, and therefore, to minimize the risk, they classify the risk as diversifiable, non diversifiable. Diversifiable is to be diversified, eliminated. Followed. All investors want to maximize the wealth, meaning what? When you are doing inter CMA, financial management, the first lecture we teach the students objective of financial management is maximizing the wealth of the shareholders. So maximizing the wealth. So portfolio will be selected only on the basis of risk and return assessment. Third, all the investors can borrow or lend unlimited amount of funds at risk-free rate of interest. At risk-free rate of interest. All investors have identical estimates of risk. That means what is risky for you is risky for me also. And the returns of all securities. We have got identical way of thinking as to how much will be the returns and how much will be the risk. All securities are perfectly divisible and liquid, and there is no transaction cost of or tax. This is an assumption. Assumption. No transaction cost, no brokerage, no commission, etc. No tax, no STT, no capital gains tax. There is perfect competition in the market. Investors are efficiently diversified and have eliminated the unsystematic risk. So these are the 7 assumptions of your CAPM theory. Now CAPM theory, we have studied formula for CAPM theory in inter, but in inter we studied the formula as cost of equity is equal to RF plus beta into RM minus RF. Correct, na? This is the formula. Now the same thing, instead of KE, which is cost of equity, I replace it with RS, returns on security. So this formula is important for CAPM theory. RS is equal to RF plus beta into RM minus RF. Clear? Now, in that RM minus RF is what? It is the market risk premium. Market risk premium, market premium, market risk premium. But when that is multiplied to beta, it becomes a risk premium of that particular security, because every security has got a different beta. So when we multiply the market risk of premium to the beta of the security, then it becomes the it becomes the risk premium of the security. Okay, risk-free rate of return. It is normally the returns on government securities or treasury bills. Okay, so that is given as your risk-free rate of return. Up till here, everything clarified, everything clear. Shall we move ahead? Shall we proceed? Okay, now what we are going to do is going to be very important for you. Every step we are learning some new concept, we are learning some important concept, we are learning some very important concept which is necessary for us to know at final level. Okay, now Let us come to the concept of efficiency frontier. Okay, now we have always been maintaining, we have always been maintaining that any investor, when he is investing, he will be told, look, you are having some risk. So he will decide as to how much risk he can undertake. He will decide how much risk he can bear. And on that basis, he will be investing in the stock. So when he invests in the stock, he will invest only in efficient stocks. Investor will invest only in efficient stocks. Now, how to find out which stock is efficient? What is the meaning of efficient stock? Meaning of efficient stock is similar to what you have done in portfolio management, optimal portfolio. Okay, optimal portfolio. So like that, optimal stock or efficient stock. Efficient portfolio. Efficient portfolio is that portfolio where for a given level of risk, if I tell you I can bear only this much amount of risk, for a given level of risk, the returns are maximized. Or I tell you I want this much amount of returns. So for a given level of returns, the risk is minimized. For a given level of risk, returns are maximized, or for a given level of returns, risk is minimized. Efficient stock. Okay. Now let us come to the diagram. Diagram is very important. Understand diagram, everything you have understood. Okay. So diagram says that I have got stock or I have got portfolio B. I have got portfolio B or I have got stock B, which is giving me R3 rate of return and having a risk of, here I am measuring the risk. Here I am measuring the returns. X axis I measure the risk, Y axis I measure the returns. So when I select stock B or portfolio B is giving me a returns of R3. Okay, and what is the level of risk involved? The level of risk involved is sigma 2. Level of risk involved is sigma 2. Now, when I look in the market, I find that array, for the same level of returns of R3, there is another stock which is having less risk. Same returns, but less risk. So for a given level of returns, R3, minimizing the risk is optimal portfolio. So I will shift from, that means I have now stock A, which is better than stock B. Stock A, this one, is giving me the same returns, R3, but it is having less amount of risk, sigma 1. So I say that A dominates B. A dominates B. Why? Because the same returns can be obtained at a lower level of risk. Then I find, array, there is one more stock, that is stock C. Stock C, where for the same level of risk, sigma 2 is giving me higher returns, R2. Same level of risk, for the same risk, I'm getting better returns. I'm getting higher returns. So C dominates B. Likewise, C will be dominating D, E will be dominating D. So when you collect all these portfolios here, A, C and E, and you draw a curve passing through all of them, it is called as efficient frontier. That means efficient frontier is representing those portfolios or those risks which are those securities or those portfolios which have minimum risk for a given level of returns or a maximum returns for a given level of risk, and they are all efficient portfolios. So A, C and E, when you join, you get a curve which is called as the efficient frontier. So that curve is the efficient frontier for you. Okay, the curve is the efficient frontier for you. Understood? Any difficulty now? So this curve that is there, that is ACE, is the efficiency frontier. Up till here it is clear. So what we were doing, we were doing efficiency frontier. What is efficiency frontier? All the securities on that efficiency frontier will be efficient portfolios. We can find a set of portfolios which offer higher returns for the same level of risk or lower risk for the same returns, and that is the set of efficient portfolios. So A, C and E are all A, that is this point, C, that is this point, and E, that is this point. They are all set of efficient portfolios. What is the indication of this? Use of efficiency frontier. If a stock falls below the frontier, the stock is dominated by some other security and hence it will be rejected. That means if I have over here any particular stock, let us say here I have stock P. So that will be rejected. Why it will be rejected? Because there is some point on this efficiency frontier which will give me the same returns at a lower level of risk, or it will give me for the same risk a higher level of returns. So P gets rejected. Okay. So if the stock lies below the frontier, then it will be rejected. If the stock lies on the frontier, if I have Q over here, then it is an efficient portfolio and it will be selected. Okay. And if I'm having something over here, let us say stock M is over here, then I say that array, now M is dominating C, so I will have to change my efficiency frontier and it will be passing through M. This is my efficiency frontier. So if the stock is lying above the frontier, that means that stock is dominating some security in the original frontier. So we have to change the efficiency frontier curve itself. Okay, that is given to you. Stock lies above the frontier, stock dominates some security on the earlier frontier, and hence a new frontier has to be drawn. Up till here it is clear. Any difficulty? Shall we proceed now? Lot of theory is there, I have told you. Now I want to explain to you, what I will be doing is I am explaining to you the concept of capital market line. First we'll read, then we'll go to the diagram, I'll explain the diagram. Okay. Capital market line is an efficient set of risk-free and risky securities which shows the risk-return trade-off in the market equilibrium. This is the concept, this is the definition. I have to explain it to you how to get the capital market line. Capital market line short form is CML. Short form is CML. Thus the CML relationship for any efficient portfolio is given by this formula. Formula is important. RS is equal to RF plus RM minus RF multiplied by standard deviation of security upon standard deviation of market, sigma S upon sigma M. Standard deviation of security upon standard deviation of market. So what do you understand? Let us compare this with, let us compare the equation of CML with equation of CAPM. Equation of CAPM, what did we say? RS is equal to RS is equal to RF plus beta into RF minus RF. So what is the difference in the two? Your beta gets replaced by standard deviation of security, that is risk of the security with risk of market. That is the difference between the CAPM and the CML. This particular equation represents SML, security market line. It is an equation, it is a linear equation. So that means there is a straight line. That is your straight line is called as security market line. This is called as CML, that is capital market line. So in one shot, I have explained to you what is SML and what is CML. In SML, we are taking only beta factor for comparison. We are taking only the non-diversifiable or systematic risk into consideration, whereas in CML, we are taking into consideration the total risk, that is standard deviation. Point is clear? Okay. So understand the difference in the formulas now. CML, if you are told that the stock is lying on the CML, then you have to make use of this formula. Otherwise, for CAPM, I'll be making use of this formula. Okay. CML versus CAPM. CML sets forth the relationship between the expected return and the risk for efficient, well-diversified portfolios. Whereas CAPM is a pricing relationship that is applicable for all securities and portfolios, efficient as well as inefficient. So in CML, we are considering only the efficient portfolios. In both the CML and CAPM, the appropriate measure of risk is the systematic portion. However, CML assumes well-diversified portfolios. Therefore, it will take into consideration total risk of the portfolio. Okay. Now, let us come to this nice little diagram that I have given to you. Got it? What do you see? You see an umbrella here. This is umbrella A, B, M, C, D, E, F. It's an umbrella. If I draw this line here, it's an umbrella. Okay. Now, what is this umbrella actually? What is this umbrella actually? This is nothing but my efficiency frontier A, B, M, C, D. This particular line, this particular curve is my efficiency frontier. And what is efficiency frontier? A combination of all efficient portfolios. All efficient portfolios. Now it means that on this particular curve, any portfolio is better than the other. Any portfolio is better than the other that is lying here. So B is better than F, B is better than E, E is better than some portfolio point over here will be better than F, D is better than F. So we are having below the curve inefficient portfolios, on the curve efficient portfolios. Now these efficient portfolios are portfolios made up of risky assets. So efficiency frontier represents portfolios which are efficient portfolios. Efficient portfolios. Okay, efficient portfolios, but also risky portfolios. That means it will be carrying some amount of risk. It will be carrying some amount of risk. Now, if you see here, R is written. This point, this is my standard deviation. On the x-axis, I measure standard deviation. And on the y-axis, I measure the returns. This point over here, standard deviation 0. That means it is a asset which is having no risk. So risk-free asset. When I draw a tangent from this particular point, to the efficiency frontier it meets over here at M, and this is called as market portfolio. So what is a market portfolio? Market portfolio is a combination of risky and risk-free asset, which is the optimum level, which is the optimum stock or optimum portfolio, giving us the best possible returns for a given level of risk. This particular line is showing us the tangency with the efficiency portfolio. So in that case, what happens? In that case, this particular line is called as the CML. This line is called as a capital market line. Okay. So in this way, we understand the concept of capital market line. We understand the concept of efficient frontier. So first I started with efficiency frontier. Then I went to capital market line. But before that, we had done CAPM theory also. So we have learnt a lot of things over here. Correct? Any difficulty? Up till here, everything is clear. Okay. Shall we proceed? So we have done, you can say, large part of theory is done, but we still have to do a lot more. Right? So let us continue from here. So up till now, we have done CAPM theory, that is capital asset pricing model. In this CAPM theory, what we have done is we have said RS is equal to RF plus beta into RM minus RF. Am I right? Now, this is one particular factor that is affecting, that is supposed to affect my company and all other companies in the same line of business. But if you go to see, first, there is no one single factor which is affecting a company or a group of companies or industries. You have several factors affecting companies. For example, you have interest rates, forex rates, inflation, taxes. Okay, so all these factors affect different companies. It is not one single factor. Second, even if there is one single factor, but one single factor is not going to affect all the companies in the same manner. For example, forex rates, if they change, it will be affecting only those companies which are involved in import-export business. If the companies are not involved in import-export business, then whatever may be the rate of exchange between dollar and rupees, between euros and rupees, between yen and rupees, if I'm not having any import-export business, if I'm not importing anything, if I'm not exporting anything, I'm having only local trade, local business, then in that case, forex rates are not going to affect my company's results, my company's returns. So there is this limitation which is there in CAPM theory. Essence of CAPM theory is that investors will be rewarded only for the systematic risk. They will not be rewarded for the unsystematic risk. Now, if you go to see, we are measuring standard deviation that involves total risk. Now, we have to see how the concept of return and the concept of risk is defined under what we call as the arbitrage pricing theory, which is the second theory which has to be done in detail by all of us. Okay, so let us start with that. Concept of return. In this theory, the returns of a security are supposed to have two components, very important, because this is the crux of the theory, this is the main part of the theory. They are supposed to have two components. What are the two components? The predictable and the unpredictable. This is how we define it. Something that can be predicted and something that cannot be predicted. What can be predicted? The rate of interest on government securities. Rate of interest on government securities can be predicted. So that is a predictable portion. So the predictable part is called as the risk-free rate of return. Predictable, 7%, 6%, whatever it is. The unpredictable or uncertain returns arises from future information, that is dividends of the company. That depends upon future information as to how the company is to perform, how the company will be increasing its revenues, what are the new projects that will come up, what are the new ventures that the company has accepted. Concept of risk under APT. How do we define risk over here? In CAPM, just one factor was there, okay, and this was reflected by beta. On the other hand, APT, what is the difference here? APT assumes that market risk can be caused by economic factors such as changes in GNP, gross net product, national product, interest rates, forex rates, inflation, and each company may be affected differently. So the difference between what we have done in CAPM and what we are doing now in APT is that in CAPM we consider only one factor. In APT we are considering several factors. In CAPM we assume that it was only one factor or that all the factors were giving us the same result. In APT we are saying no, that there are different factors which are affecting the company. And we are also saying that they are affecting different companies differently. So under APT there are multiple factors, and for each factor, for each firm, there will be as many betas as the number of factors. So if a company is being affected by inflation, interest rates, and tax, there will be three betas for this. If a company is affected only by inflation and interest rates, there will be two betas for that company. So each company will have as many betas as the number of factors. So we will have multiple betas. Okay, that is the difference. So now you can see here, using the sensitivity of the firm to two or more such factors that are relevant, we have this formula. Can you see the difference in the formula? The CAPM formula has now expanded. We had only up till here, but now it has expanded because we have got beta 1, beta 2, beta 3, up to beta n. Up to beta n it will be there. That will be RFN minus RF. Now what is this bracket over here? This particular bracket over here is nothing but the factor premium. It is a factor premium. Okay, so it is a factor premium. Just like we had market risk premium, here it is a factor premium. So RF1, RF2, RF3 are the three economic factors affecting the returns of the security. Beta 1, beta 2 and beta 3 are the measures of the three economic factors. Okay. Now, analysis of beta factor I will do at a later stage. I want to come down to concept of alpha. Concept of alpha. We have seen what is beta. Analysis of beta I will do later on. Concept of alpha. Concept of alpha, first I have to tell you that you have to remember this formula. This formula is for calculation of alpha. So wherever you require alpha to be calculated, formula is S bar. S bar means security returns, average security returns. Average security returns minus beta into RM. RM is market rate of return. Beta into market rate of return. Okay, so that is your formula for alpha. What is it actually? It is actual returns minus expected returns. Now, what they are saying, let us see what is the concept of alpha. The beta value is used to calculate what should be the returns on a single security of a portfolio relative to market returns. But there can be securities which are giving returns either higher than or lower than the returns shown by CAPM. What they are saying, beta is used to calculate. We are going back to CAPM now. For CAPM, formula is RS is equal to RF plus beta into RM minus RF. So there we are saying that we use this beta value to calculate what should be the returns RS on a single security. But there can be securities which are giving returns either higher than or lower than the returns shown by CAPM. Actual returns may be different, expected returns may be different. Alpha is an indicator of the extent to which this actual stock returns of a stock varies or deviates from those predicted by its beta value. So, definition of alpha. It is an indicator to the extent of which the actual return of a stock varies or deviates from those predicted by its beta. That is why it is called actual returns minus expected returns. Okay. So, what is the method of calculating alpha? First, you compute the required rate of return as per CAPM. This is the first step. Second step, compute the annual returns for a set of observations. Third step is difference between the two is calculated. That is actual minus expected returns. That is calculated. And then the simple average of the differences. That is, if you are having 4 values, observed values, divide by 4. If there are 3 values, then divide by 3. If there are 6 values calculated, divide by 6. Simple average. So, to understand that, I have given you an example here. Let us go through the example. Fire Limited has a beta of 1.15 and the return on market portfolio RM is 14%. If the risk-free rate is 5%, that is RF is 5, what would be the expected return on the shares of Fire Limited? That will be as per CAPM. Then second part of the question says, if the actual returns over 4 observations, that is for 4 years, are as follows, what would be the value of alpha? So they have given the returns on fire, make the correction there, it is 18%, 12.5%, 15.35 and 16.53%. First to calculate returns on the portfolio, on the security. So RS is equal to RF plus beta into RM minus RF. RF is 5, beta is 1.15, RM minus RF 14.5, 14 minus 5. So you get the returns on the security as 15.35%. 15.35%. Now deviations between the observations and the required returns. Okay, 4 observations we have got for 4 years. So difference between this observation 1 minus 15.35. So 18 minus 15.35. Then 12.5 minus 15.35. Then 15.35 minus 15.35. And then 16.53 minus 15.35. This we get 3 values over here, 2.65 minus 2.85, 0 and 1.18. Simple average of that is taken. So minus value is subtracted, you get 0.245, 0.245. Now, interpretation of alpha. What do you mean by this 0.245? I am not concerned here again with the number. I am concerned whether it is positive or negative. Okay? A positive alpha, in this case it's a positive alpha. It's a positive alpha. A positive alpha indicates that expected return from this stock could be higher than that mandated by CAPM. So if you're looking at this, expected is higher than what you are having. So it is positive. Expected is higher, 16.53, 18.535, 18%. So most of the time it is higher. Here it is equal, here it is less. So most of the time is higher. So the possibility of it being higher is more. So if it is a positive alpha, stocks with the positive alpha should be considered as undervalued stocks. So if there is undervaluation, we purchase. If there is overvaluation, we sell. So here it is purchase. Undervalued, so purchase. Negative alpha indicates that expected return from the stock will be less than that mandated by capital to the extent of the alpha value. Therefore, they are overvalued stocks, and overvalued stocks should be sold. Overvalued stocks should be sold. Okay? So, this is what is the interpretation of alpha. So, I suppose that you have understood the concept of alpha. Now, we come to what we were skipping over there, that is analysis of beta. Very important point, very important point, because we have questions based on this. Analysis of beta factor. Okay? First, we will read all the 4 points, and then I will explain to you the 4 points. Okay? So first we read all the 4 points, and you will keep your book in front of you when I'm explaining to you, because each one of these points I will explain with the help of diagram. So for that purpose, you have to have these 4 points before you. So keep the PDF of your notes before you. After reading each of those points, we will put it in the form of a graph, or we will put it in the form of a diagram. First point, if an all equity company means the entire share capital of the company is only in the form of shares. There is no debt capital, and that company has got a single project, then the beta of the project equals the beta of the equity. That means beta of the company is equal to beta of the project. Risk of the company is equal to risk of the project. Second case, it's an all equity company, carries on business with more than one project. More than one project. Then portfolio of projects is there. Beta of the firm reflects beta of the asset portfolio. Risk of the firm is equal to the risk of all the projects. But all the projects risk, now we have a portfolio. Now, if I'm having more than one project, it is a portfolio of investment. So that portfolio of investment will have beta as the weighted average beta of all the projects. So beta of an unlevered company with several projects is the weighted average beta of projects of that company. Okay, so risk of the company is equal to risk of the projects, but risk of the projects, multiple projects, means that there is a portfolio of projects. First two companies were all equity company. Third one, geared company, single project. Company with borrowed capital, having one single project. Risk of the company is equal to risk of the project, but risk of the company's capital is weighted average risk of equity and debt. Weighted average risk of equity and debt. Then, if a geared company has several projects, beta of the project is weighted average beta of the equity and debt, and vice versa. Beta of the company is weighted average of all the assets constituting the portfolio. Now, to remember this, it becomes a little bit difficult. So, I would prefer to put it in the form of a diagram, and then we can understand how these 4 points work out. Okay, so I will now put all these 4 points in the form of a diagram. You will keep the PDF in front of you. As I am drawing the diagram, I will be explaining to you what is written in these 4 points. And then after we do that, I will teach you, I will tell you rather, why we are doing all this. Because I have to tell you why we are doing all this. Okay? So now I'm going to explain to you those 4 points which I told you, which you have just read. First one, what I do is only equity is there, only one project is there, P1. So it is all equity company carrying on business with single project P1. Whatever is the risk of this entire company is equal to the risk of this project P1, because there is only one project. So if the project makes a profit, company makes a profit. Project suffers a loss, company suffers a loss. So the risk of the project is equal to risk of the company. Vice versa, the risk of the company is equal to the risk of the project. So both ways it works. Risk of the company is equal to risk of the project. Beta of the company is equal to beta of the project, or vice versa. Beta of the project is equal to beta of the company, that is beta of the equity. Second, we had all equity company with more than one project. So we have project P1, project P2. Now together this forms a portfolio with P1 and P2. So now I can say risk of the company is equal to risk of the what is this portfolio, and so risk of the company is equal to risk of this portfolio, but risk of this portfolio is equal to weighted average risk of P1 and P2. Correct now? The risk of the portfolio with two projects P1 and P2 is equal to the weighted average risk of the two portfolios, two projects. So I can say that risk of the company is equal to the weighted average risk of the assets of the company. Correct? This is all equity company. Now I have company with equity plus debt. Equity plus debt. And this company has got only one single project. So what do I say now? Risk of the company is equal to risk of this one project. Conversely, risk of this project P1 is equal to risk of the company. But risk of the company is made up of two factors. So I say that risk of the project is equal to the weighted average risk of the capital of the company. Weighted average risk. Followed? Equity plus debt and more than one project, P1, P2. Two projects are there. So there is a portfolio of investments. So geared company having several projects. Risk of the company is equal to risk of the portfolio, which is weighted average risk of the two projects. So risk of the company is equal to weighted average risk of the two projects. And at the same time, I can say that risk of this portfolio or risk of the assets is equal to weighted average risk of debt plus equity. Weighted average risk of debt plus equity. These are the 4 points or 4 cases that we have discussed. Now, why we are doing all this? What is the importance of this? Where this is going to be used? Let us say I have got a company. Okay, let us say I've got a company X Limited, and this X Limited is financed by equity plus debt. It is financed by equity plus debt. So it is a geared company. It is a levered company. This company is now going to finance a project. Okay, it is now going to finance a project. Let us say project A. Now, what is going to be the way in which it is going to finance? It is going to finance only by equity. Only by equity, no debt. So a geared company, pay attention to this. A geared company is financing a project which has got only equity. It has got no debt. Risk of this company will be equal to the risk of this project. But I can't say that now. Why? Because the project is financed only by equity, whereas here it is equity plus debt. Company is having equity plus debt. So risk of the company is a weighted average risk of equity plus debt, but it is not equal to the weighted average risk of equity plus debt over here, because this is only financed by equity, only financed by equity. So this has got a geared beta. What do I say? This has got a geared beta. But that beta is not applicable for this project A, because this project A is a unlevered project or an ungeared beta. So I require now conversion of geared beta into ungeared or unlevered beta. Okay, so how do I write this now? Unlevered beta is equal to geared beta. This is the formula which we are going to make use of. Ungeared beta, conversion of geared beta into ungeared beta. Why do we have to convert? Because a company which is a levered company, a geared company, having debt plus equity, is financing a project only with equity. Only with equity. So conversion of a geared beta into an unlevered beta or an ungeared beta multiplied by geared beta multiplied by equity upon equity plus debt net of tax. Okay, so this is how we are going to solve problems. This is the formula for conversion. This is the formula for conversion of geared beta into ungeared beta. Okay, so that is why we had done this analysis of beta factor. All these things were done with the objective of finally showing you this particular part. This is important for us. Conversion of geared beta into ungeared or unlevered beta. So this completes all my theory part, and I want you to go through all this theory part once again in detail so that we can start with the questions, we can start with the problems. Okay, so this lecture I end over here with the theory, and in the next session I will be starting with the problems based on this. So see that you revise all your theory concepts thoroughly so that we can start with the problems as soon as possible. Okay, till the next lecture, till the next session, stay at home, stay safe, God bless you.